Welcome back, everybody. It's good to have you to another real estate market update for the greater Milwaukee area. This time, April 2025. To be precise, Monday, April 7th. We are about 1 week into the new tariff system that is sending shockwaves through the stock markets globally and is bringing up recession concerns. So the stock markets are not taking it very well. I actually meant to take you on a deep dive this month on what's happening with Milwaukee prices and how much buyers and sellers have been negotiating, as we have a full data set for Q1, but actually that has to go on the shelf, and we need to talk about what's going on in the stock market and with the economy and how that is going to impact the real estate market. There's already a whole lot about this on social media, and I'm sure you've seen some of that. Most of it is more clickbait and not very factual. So, of course, this situation is impacting the real estate market, but in several ways actually, but probably not the way you're thinking. So I'll do my best to walk you through on what happened so far and what we need to pay attention in the future. But before we get there, let's take a quick look at the latest data from MLS. So this is looking back, this is March. So none of what you're seeing here is impacted from what has happened in the economy in the last few days. So inventory is up 22%. We're at 1,463, as you can see from the historic numbers below. That is still a very, very tight inventory. And by the way, I have narrowed down the scope. We're now looking at data at the 4 counties surrounding the Milwaukee metro area, including Milwaukee County, obviously. So a little smaller data set, but a little bit more specific to the Milwaukee metro area. Closed units 787, little down, but basically in line. Days on market are getting faster, 7 days. The reality is that we're already ahead of this, so good listings are selling in 2 or 3 days now. And with that, the median sold price is up at $365,000, and that's up a little over 8.6% from last year. If you look below at the historic number from March 2015, you can basically say that real estate prices in Milwaukee have doubled in the last 10 years, a little bit more actually. All right, what are the market trends that we are seeing? February price increase was an outlier. If you remember my last month market update, I've reported from some news that Milwaukee is the hottest market in the US with a price increase of 20%. I would say that, generally the direction is true, but this was really an outlier because February the prior year was extremely low. So when you measure the gap from February to February, that was pretty strong. You can see it here. March over March, we are at 8.63%. That's more in line. And I did take a look at Q1 year-to-date price increase was 11.1% over Q1 last year. So you always want to look at a little bit larger data set because that eliminates the outliers that you have in 1 month. Like I always say, 1 month is not a trend. So we are still double digit here with 11.1%. So home prices are going up significantly in Milwaukee. And we're probably still in the top 3 or top 5 markets of the US. And if you watch the evening news and they're talking about the real estate market in LA or in Miami doing something totally different, then just know this is normal. We are in a time period where markets are behaving very, very differently depending on where you are in the US. You can also go back to my March market update and look at what I was talking about in Florida. They have a completely opposite day and night opposite situation that we have here. So their market is in a very, very different shape than we are. Spring inventory is finally arriving. We're seeing it now every week. There's more inventory coming on the market than previous week. Very high market velocity. All the good listings that are coming on the market are selling basically on their first weekend. And if it's an attractive listing, meaning a good price, well presented, good staged, good marketing, and just overall a good property, then 3 to 5 offers are the norm. And of course, the competition then is driving up prices. I'll give you a little bit of the data that I meant to present today, just so you have a high-level idea. So 62.5% of all offers that have been accepted in the first quarter were over list price. So about roughly 2/3 were over list price. We had about 14% that were at list price and about 23% that were below list price, so people ended up negotiating. A question I got this morning on social media is how was the last weekend, probably in reflection of the stock market crashing. And I can tell you anecdotally, it did not feel very different to me. So I went on the MLS this morning to pull up some data, and I'm literally reading this from a post-it note because I haven't had time to make a slide for you yet. But the weekend before tariffs and before the stock market crash, and the whole Milwaukee metro area, we had 96 accepted offers on the weekend prior. And this past weekend after the stock market crash, we had 106 total accepted offers. So I don't really see a change in the data. I think a lot of people are expecting this because, it's in the headlines, it's in the news. Of course, it's impacting everybody. Everybody's a little bit in shock with what is happening here, but it doesn't really seem to impact the immediate market right away. But there are going to be some implications that we are already seeing, and so that's what I want to talk about today. Before we get there, here's a quick shameless plug for our team. In times like this, it matters who you're working with. So if you have moving plans for this year, then definitely let's talk about this. Most people just send me an email at m.auerbach@kw.com. You can also go to my website, onpointrg.com, and you'll find a red button there that says schedule a call with Marcus. And you can see my schedule there. You can pick a day and a time that works for you, and then we'll have a phone call or a Zoom call depending on what you prefer. And by the way, I saw Cody Sanchez on YouTube the other day saying, "Oh, you have to call 3 real estate agents before you get one on the phone." I dare you to try it. Give me a call, 262-671-6868, and don't be surprised if I pick up, because that's actually what I do. All right, so with that, let's go back to the data. Inventory is slowly improving. We have seen it in March. Our buyer clients that are currently out there are speaking to it. They're happy that finally some stuff is popping up on the MLS. And you can see we're still relatively low in March. If we're getting to 14 and 1600 as we have been last year in spring, I don't know it yet. I think that's going to be the direction. It looks like my service providers are telling me they are busy. My photographers are booked up. The stages are booked up. So it seems like there is more inventory in the pipeline, but it will not be earth-shattering different. So I think best case, we're being somewhere here around 1600 units here in a little while based on where we are right now. Let's take a look at competitiveness. So this is a list to sale ratio. We are back at over 100%, which is highly competitive with 101%. If you follow my channel, you know this, but in case you're not, the sale to list ratio basically measures how much buyers and sellers negotiated and how much buyers ended up paying under or over list price. Historically, this was always like 95-96% in a normal market. So for a few years now, we've been in this highly competitive territory. And you can see last summer, we were at almost 103%. So we had a lot of offers written at 5%, 10% over list price. I'll make another video. I'll take you on a deep dive to what is actually going on, what that means in dollars in different neighborhoods. But we're skipping this for today. Just know market has been heating up in March. We're back in the over 100% sale to list price ratio. So on average, people are paying more than what the seller is asking for. All right, let's take a look at the headline for today. What's going on with the stock market? I have here all 3 major indices. We have your S&P 500, Dow Jones, and the NASDAQ, and all of them are deep red. I just glanced over here on my other screen. Looks like Monday morning is also not starting out well. And I'm not a stock market expert, but it will be probably a while for the market to digest this, because this is such a change to the global trade environment, and the market will take some time to work through this. So that's my standard expectation. Of course, it's hitting a lot of us hard. If you have checked your 401k, that, may look a little bleak. As of Friday, this is when this chart was from, we basically wiped out the profits that we have seen in the last 12 months, and we're back to where we were a year prior. So, everything is connected in a financial world. So, of course, there are implications to the housing market, and I want to walk you through on how that looks, because it is not what most people assume. The stock market is not the same as the real estate market. The real estate market works very differently. The stock market can literally turn on a dime. Prices change overnight. Markets can collapse very quickly, as we're just currently experiencing. And the real estate market is moving more at a glacial pace. And that has to do also with the fact that real estate works very, very differently. And let me just set the stage by walking you quickly through how that actually works in a real estate market. So first of all, in the stock market, everybody can be a buyer one day, and the next morning the news are bad and everybody is a seller. You don't need a stock to go home to sleep at night. So you can literally have 100% of all people that own that stock go on the market at the same time and say sell. And of course, that's not good for prices. In the real estate world, that cannot happen, because then everybody's homeless. So that is changing the dynamic very, very substantially. In the housing market, sellers provide the supply. So there is a caveat there, because builders are also sellers. So if you see a lot of builders putting out a lot of inventory, that also changes supply. But supply is a very non-elastic factor in the real estate market. It is what it is. It doesn't change very quickly. Buyer demand can change, and buyers are in the end the ones that are determining the sales price. So if you have more buyers than there are sellers, then there is competition that's driving up prices. If that is not happening, then inventory starts building up. And that is the reason why I always talk about inventory. Inventory is the first number I have every month on my market update. And when inventory gets really high, and we are talking about 4 or 5 months worth of inventory, at the moment we're at 1 month of inventory, so very, very low inventory. But if inventory gets high, then prices start to get negotiated more. You can currently see this in the Florida markets, where you have a sale to list price ratio that's more around 95 and 96% compared to Milwaukee, where we've just seen 101%. So this is how prices are made. So buyers and sellers are negotiating. If the buyers are offering a too low price, then sellers may just decide they're not selling it, because they don't want to accept an offer that is that low and that much below the list price. So then it comes down to the fact, do sellers really have to sell, or do they only want to sell? Because if they don't have to, then many of them will just expire the listing, they cancel their moving plans, and it's not going to happen. This is why real estate prices historically, when you look at the 100 years, they are downward sticky, because sellers can usually decide to just not sell and wait until the overall situation improves, whatever it is, mortgage rates, recession, the economy, etc. Let's look at some historic data in terms of how real estate prices and the stock market correlated or did not. And you have here in green the real estate market. That's a Case-Shiller index, and for all of the US. And then in red you have the stock market. And we have some areas here where the stock market has crashed. You'll remember maybe the crash from the dot-com crash after 2000. So this is a prime example of the real estate market being completely unfazed on what's going on in the stock market. Very different situation we had in 2007, 2008, but that was also different in its made-up. That was not an economic recession. That was a subprime mortgage crisis. People got loans that didn't qualify, didn't have an income to pay back those loans. So this is what is in everybody's mind. So people are linking recession with housing market crash, but the causality is important here. Back in 2008, it was actually a subprime mortgage crash crisis, foreclosure crisis that eventually resulted into an economic recession, not the other way around. Back in 15, 16, we had a stock market correction. You can see housing market did nothing. By the way, these little wavy things, those are the seasonal up and downs. Then we had, of course, the crash 2020 with COVID, another correction here, and now we have the next one. So not really a correlation there between the stock market and real estate prices. Let's take a look at recessions in general. So I have data here going back to 1980. These are the last 6 major recessions that we have seen in the US. And you can see in most of them, real estate actually went up in price. 3 times we had over 6% price increase. And then we had 91, we had a little bit of a decrease here. And then, of course, 2008, we had the big mortgage crisis. So real estate doesn't really respond to economic recessions. And the question obviously here is, why is this happening? And there is actually a very good answer to this, because economic uncertainty benefits usually hard assets, safer assets, because money is leaving the volatile stock market. Money is trying to find a safe harbor. Investors are trying to find a way how to, where should I put my money to shelter it from inflation, to shelter it from the stock market. And oftentimes hard assets profit from that. So, the typical example is, of course, the gold price. You may have seen that in the news that we had a record gold price. Bitcoin is also going in the same direction. That's also providing a safe harbor. This is why we've seen the rallies in Bitcoin and in gold in the last half year, a year, the way we have seen them. But also real estate is considered a safe harbor, because real estate is a hard asset, just as well as natural resources and also machinery and equipment. But if you're managing a large amount of money, if you're a pension fund, if you're an institutional investor, and you are managing billions and billions of dollars, it's not that quick to buy some machinery or to buy some real estate. So you need a paper asset that is providing safe harbor protection, and that is typically the bond market. So what we're seeing right now is that money from Wall Street is going into the safer bond market, and that is driving down bond yields. So you can see here a chart of the 10-year US Treasury from the beginning of the year until last week, and we hit a record low on Friday for the 10-year Treasury. The reason why this is happening is because investors basically have the choice to, when they take the money out of the stock market, they can say, okay, do I buy government bonds, or do I buy mortgage-backed securities? Mortgage-backed securities are usually a little bit higher, and that's the reason why the bond market or the 10-year Treasury and the 30-year fixed-rate mortgage always correlate. We've seen this over the last 60 years. I've explained this in the past here on the channel, so I'm not going to repeat that. But if you want to know where mortgage rates are going, then take a look at the 10-year Treasury, because that's the investment alternative for very large funds. So that's basically good news for the mortgage rates, and you can already see it materializing here. I got the 30-year fixed rate, and for the last half year or so, we have been locked in that blue box here, basically in the high 6s to low 7s. So in a nutshell, bad news for the economy is actually good news for mortgage rates, because they are dropping, and that's making it more affordable for buyers. I think that's obvious. What most people forget about is that it is also good for sellers, because 72% of all sellers are also buyers. They need to, when they sell their house, they need to buy another one to move into. And if the current house is financed with a 3% mortgage rate, then the idea of buying a new house with the 7% mortgage rate is, of course, not very appealing. So they're kind of handcuffed to their old mortgage rate. And you can see this reflected here in this statistic. At the current mortgage rate, not a whole lot of people are interested in listing the house, but as we're going down in mortgage rate, here below 6 into the 5s, you can see a much bigger percentage of wannabe sellers would actually consider putting the house on the market and make that move. So that would actually help the housing market, and it would bring more listings on the market. For buyers, it is also obviously beneficial. You can pause this video and look at the numbers here in detail if you want to. The big takeaway is basically 1% in change in mortgage rate equals about $50,000 in more house that you can afford, with still having the same payment around $2,500. So you can drive in the chart up and down, and you can see how that is changing the home price at roughly the same monthly payment. So big impact there. Let's take a look at big picture where we are with home prices in Milwaukee. This chart shows you in green the Milwaukee metro area of the last 15 years. And then in red, that is the national home price for all of the US. So not the expensive markets, it's just average. And I've been saying this for years. If you travel a little bit, Milwaukee is not a below average city, and it should not, the real estate should not be priced below average. So I'm expecting that the gap will narrow over the next years. And we're seeing this already. The national market has gone up really crazy in the COVID years, and now it's kind of like stabilizing and going a little bit more sideways than up. So there's a normalization here. And the trend is probably going to be somewhere, slight increase is what the experts are predicting. For the Milwaukee market, we are in a steeper trajectory, in a very intact trend. So we'll probably see a repeat from last year's spring market. And with that, the gap between Milwaukee home prices and the national market is getting smaller and smaller. So what I'm expecting for the next few weeks, when I'm looking at my crystal ball. So of course, the stock market, the economy, inflation, mortgage rates, everything impacts the real estate market. And I'm going to continue to monitor the data and give you regular updates so you can see what's actually happening here in the Milwaukee real estate market. From what I can see so far, the market is not two-phased. You've heard me mention the numbers here from my posted from 96 accepted offers to 106. So that doesn't really show much of a slowdown, if anything to the contrary. It's possible that we're going to see more cash offers in the future. I've seen that at the last stock market correction that people have liquidated their portfolio, didn't want to leave money in the stock market, so they decided to go real estate instead. Mortgage rates could improve slightly. It's very difficult to forecast mortgage rates anyways, because there's like 20 different global economic factors that are factoring into these financial markets and how they are impacting mortgage rates. But at the moment, there is a good probability that we might see rates getting a little bit lower than they currently are. More spring inventory to come in the next weeks. My photographers are busy, my stagers are busy. So they're booking out. That is telling me I'm not the only one who has listings in the pipeline. And with lower rates, we're going to see more sellers, but also more buyers. So overall, I don't see, based on the information and data that I have today, a big change in the market. If you're thinking about moving, let's talk about your plans. Preferably, let's make a strategy early on, because then I can still have a bigger impact and help you more than if you bring me in the last minute. You have my contact information here, and also below this video in the description, there's my phone number and my email address and everything else. What do you need to successfully compete as a buyer? This market can be super frustrating if you're on the buying side, if you don't have really good advice on how to write strategically good offers. We can help with that. Book a call with me. You can go on my website, onpointrg.com, pick a date and a time that works for you, and I'll see you on a Zoom call. That's all I had for you today. Thank you very much for watching, and I'll talk to you soon.